Well, good morning. I'm Jagender Rana. So we are discussing today consolidated solvency ratio. Consolidated solvency ratio. The consolidated solvency ratio of the insurance sector remains above the minimum threshold, the limit of 150%. As insurance liabilities are contingent upon future events, a higher solvency ratio implies resilience of the insurers to withstand future uncertainties. This ratio is a measure of insurers' capital adequacy. At 202%, as at June end 2024, the aggregate solvency ratio for life insurance companies has remained above the prescribed threshold for the industry, public sector 199% and private sector 210%. So at 167% as at June end 2024, the aggregate solvency ratio for non-life insurance companies has remained above the prescribed threshold for the industry, public sector 31%, private sector 227%, standalone health insurer 208%, and specialized insurers 855%. So the solvency ratio for the three public sector non-life insurers, however, stood below the baseline prescriptions. It remained well above the threshold for the rest of the non-life insurers categories. The solvency ratio of an insurance company assesses its liability or its ability to meet its obligations towards policyholders by reflecting the level of its assets over its liabilities. So the higher the solvency ratio, the better the ability of the insurer to meet its liabilities. The Insurance Regulatory and Development Authority of India has set the minimum solvency ratio, a requirement for insurance companies in India, at 150%. Life insurance premium income has been consistently increasing, aided by rising disposable income, regulatory reforms, promoting ease of doing business, and rising awareness on the need of insurance, among other factors. So the total insurance premium collected by life insurers increased to rupees 3.99 lakh crores in April-September 2024 from rupees 3.51 lakh crore in April-September 2023. Registering a growth rate of 13.7% growth year-on-year basis. So similarly, new business premiums of life insurance industry grew by 19.5%, reaching rupees 1.89 lakh crore in April-September 2024 from rupees 1.58 lakh crore vis-a-vis April-September 2023. The increased awareness of risk management and the need for financial protection has contributed to significant growth in recent years, with the total premium underwritten by general insurers and health insurers reaching rupees 1.54 lakh crore on the current financial year, exhibiting a 7% growth year-on-year for the FSR. So among various lines of business, the health insurance segment, the largest among the non-life insurance sector, has reported the highest growth of 8.95%. So as insurance companies, solvency ratio is a ratio that measures their financial health and outstanding amounts such as debts, liabilities, etc. You can use this solvency ratio to find out if your preferred insurance company is financially sound and even if they can make your payments when they are due. The insurance companies with the solvency ratio may be struggling with money and could delay payments or not pay you or family at all. On the other hand, the insurance companies with high solvency ratio are financially capable to pay you and your family, and some assured money back policies, life insurance, death benefits, or other payments. Further, the solvency ratio of your preferred insurance company is a critical criteria to consider to find out if they can or cannot pay their outstanding amounts to you or your beneficiaries. A solvency ratio lets you know if your insurance company can carry out their financial responsibilities and settle claims ideally. So ideally, you should be looking to purchase policies from companies with a high solvency ratio to guarantee that you will get your money back in policies such as money back policy or pension plans, or that your family will get your death benefit or some assured. The Insurance Regulatory and Development Authority of India scrutinizes insurance companies' solvency ratio to protect policyholders and their families. There is a required solvency margin that the IRDA enforces, which is a safety cushion that goes beyond the liabilities. So according to IRDA, insurance companies should have an RSM above their minimum solvency ratio of under 50%. Now the question is how is solvency ratio calculated? An insurance company's solvency ratio can be determined by calculating their assets against their liabilities. So the solvency ratio value shows you the insurance company's financial status and if their assets or liabilities are keeping the company afloat. For someone investing in term insurance, knowing this solvency ratio is crucial to ensure long-term security. So dividing the insurance company's liabilities against their assets uncovers their solvency ratio. Solvency ratio means net income plus depreciation divided by liabilities. Solvency ratio is equal to net income plus depreciation divided by liabilities. This calculation can tell you if your insurance company will be able to pay you or your family your payments on time. There are 4 types of solvency ratios that financial professionals use to determine an insurance company's finances. And these 4 are debt to asset ratio. The debt to asset ratio calculates how much debt an insurance company has in contrast to their assets or earnings. It can be calculated by dividing an insurance company's liabilities by their assets. Then interest coverage ratio. This calculates if and how the insurance companies use their interest in payouts. Equity ratio. An equity ratio calculates the insurance company's finances through their assets to determine if they can pay their debts. This is crucial in determining if the company will have any money left over after paying outstanding amount to pay you and your family your life insurance dues. And then debt to equity ratio. Finally, we have the debt to equity ratio that calculates an insurance company's debt in contrast to their equity earnings. This value is determined by dividing the insurance company's debt by their total earnings. So if you want to learn more about an individual insurance company's solvency ratio, you can use any of the following steps. So you can check out the IRDA's website for more information about the insurance company's solvency ratio. When you visit the IRDAI page, you can look up the specific insurance company from the list of insurance companies in India. Next, you can find the insurance company's yearly report with the most recent financials. Then you can get in touch with your insurance company for more details about their finances, or check the company's website or investor relations section for information about its solvency ratio. It is important to note that the solvency ratio of an insurance company can fluctuate over time. So it is vital to check the most recent information available. Additionally, it's a good idea to compare the solvency ratio of different insurance companies to get a better sense of their relative financial health. Even if an insurance company has a high solvency ratio, you can't base the company's financial health on this criteria alone. In addition to solvency ratio, you should look at the insurance company's finances from a holistic viewpoint. Consider their solvency ratio, their money management techniques, and how their organization stands up to competitors in the insurance market. You can compare insurance companies based on their claim settlement ratio, solvency ratio, and financial background to get a clear picture. So life insurance plays a very important role in the securing your loved ones and financial stability in case of unfortunate event. Thus, while choosing an insurance provider, you must do so with the care and after thorough research. You must ensure that your insurer is trustworthy, reputable, and will be able to provide financial support to your loved ones in their hours of need. So, keeping this in mind, one of the major factors to consider is the solvency ratio of a life insurance company. Now, the solvency ratio is a measure of capital adequacy. It is expressed as a ratio of available solvency margin to required solvency margin. Now, the excess of assets over liabilities and other liabilities of policyholders' fund and shareholders' funds maintained by the insurer is referred to as available solvency margin. IRDAI requires all insurers to maintain a minimum excess assets over liabilities, which is referred to as required solvency margin. So the IRDAI mandates a minimum solvency ratio of 150%. A high solvency ratio instills confidence in the ability of the company to pay claims, meet future contingencies, and business growth plans. So solvency ratio provides a clear picture of an insurance company's overall financial health. It takes into account the company's liabilities, cash flows and outflows. Solvency ratio in insurance companies helps you understand whether the company can manage its financial responsibilities effectively. So a high solvency ratio signifies stability, reliability, and long-term financial security. A financially stable insurance company is less likely to face insolvency. This means the chances of your claim being rejected or you losing money are less likely. So your insurance policy is a legal contract in which you agree to pay a decided amount as a premium. In return, the insurance pledges to pay the sum assured to your nominees in case of an unfortunate event. Now the insurer becomes insolvent, so they might not be able to keep their promise of payment of the assured sum, and your family might face a financial shortfall in case of an unfortunate event. Hence, to safeguard your family and ensure that the sum insured will be paid in the hour of need, you must look for high solvency ratio insurance providers. So as per the IRDAI's mandates, the minimum solvency ratio insurance companies must maintain is 1.5 to low risk in terms of solvency margin. The required value is 150%. The solvency margin is the extra capital the company must hold over and above the claim amounts they are likely to incur. It acts as a financial backup in extreme situations, enabling the company to settle all claims. That means the solvency ratio that the insurance companies declare every quarter reflects their ability to honor their promise of sum assured in case of an unfortunate event. Also, to cover your family's current and future financial needs, you need an insurance plan. The affordable premiums allow you to buy a large coverage for your family regardless of your budget. And to ensure your family is always financially secure, it is crucial to take charge of your financial life and start investing with the right insurance provider. Thank you. Thank you very much.